Is this series of corrections a cause for concern, or should we take it as a buying opportunity for Indian equities? Let's put that question to Rahul Chadha, Co-Chief Investment Officer at Mirae Asset Global Investments. He joins us on the line from Hong Kong. Rahul, good afternoon to you, or rather good evening. Thank you for speaking with us. And let me start by asking you to characterize the selling that you've seen over the last few days across global equities, but a lot more severe here in India.
Okay. If you look at global equities, it's basically the deflation fears which are pulling the market down. We've seen oil, which has corrected sharply, when you've lost close to about 50% in oil. And there are fears that some of the commodity-producing countries, particularly Russia, Venezuela, may have some bit of a crisis, or you may have some bit of a collateral damage for some institutions. So I think there's a fair bit of fear in markets and risk of deflation, which is just pulling down global markets. As far as India is concerned, we've always believed that India post-elections and with what government's doing on ground remains one of the best stories in the region, but the markets are run ahead of fundamentals, and some deflation impacts India also in terms of the weak export growth. And we're seeing on ground also that the consumer has not responded in India. And numbers are not expected to be very great in the current quarterly earnings. So I think some bit of a breather was warranted for markets. Almost everybody's overweight. It's universally loved. So some bit of a correction was much necessary, and that's what's playing out in India.
Rahul, how would you define some bit of a correction?
Yeah, I think at least 5 to 7%. So at least 5 to 7%, and then again, markets would wait for governments to act, go beyond the ordinance, and see some of these measures play out on ground in terms of improvement in IIP, improvement in manufacturing data, and eventually in next 3 to 6 months you need to see the demand bounce back from the consumer side. So it has to come in wage increases, it has to come in the feel good in the economy. Because if today we look at stocks, nobody's looking at FI16. Almost everybody is justifying stocks at FI17, which is always a tricky thing when you're sitting in Jan 15, because you're looking 2 years out. And then you get meager upsides like 10 to 15% for some of these consumer staple names. So I think clearly there are parts of markets which are stretched. So best case is time correction. And a time correction with about a 5-10% price correction would be a healthy entry opportunity.
Rahul, it's interesting you said 5 to 7% because we have corrected 6% now from the top. So are you saying further 5 to 7% from here, or are you now saying that now we need to go through the time correction, the price correction may have taken place already?
I think what happens is, again, this. We look at these quarterly numbers, and honestly, from what is estimated, like the way I said, you've not really seen an acceleration in revenue momentum here. So you may see markets be soft on this, and then again markets would look at the monthly auto data, monthly cement data before they pick up from there.
Rahul, does the currency give you any comfort? Because even today also we've seen quite a bit of strength in Indian currency, despite the kind of risk off that we have seen globally. Or do you think it's only a matter of time before even the currency has to go towards the previous lows?
No, currency clearly gives immense comfort, which is why I'm saying that should the markets correct another 5% or something, you'd be adding to the existing overweight positions, because what RBI has done the samely over the last 6-7 months is build a war chest in anticipation of this, which was much kind of an expected the dollar strength for 2015, and I think that helps quite a bit, because if you look at other markets, I mean, you look at current account surplus economies like Korea also, the currency is depreciated by 10%. Look at Malaysia and India, you've seen depreciation of close to 15%. And we are not talking of ruble or the Aussie dollar. So clearly currency gives huge amount of comfort on buying at dips.
You know, Rahul, you ascribed a lot of fundamental reasons for why reality is catching up with these markets, so to speak. I want to ask you one question from a foreign investor point of view. Do you see some pullback in, let's say, India emerging market related investments based on the anticipation that we will see a Fed move in the middle of the year, and thereafter, liquidity will be a wee bit tighter, if at all? I'm just curious to know whether that pullback is already taking place right now or getting factored in right now in terms of allocations, as opposed to happening only when the event takes place in the middle of the year or in the second half of the calendar year.
See, markets always work on anticipation, which is where, if you look at the DXY trend, and it is kind of touching new highs. You're seeing the pullback taking place in most of these markets. And like the way I said, in our regional funds, we remain overweight China, India, Philippines, etc., is success stories. But if there's deflation elsewhere in the world, growth is going to be restricted in these economies also. And I think that's where it's playing out, that almost everybody loved India, valuations are done ahead, and suddenly you realize that growth's taking its own sweet time to come, and some bit of a pullback is required and much warranted.
Okay, so just to stress on that point a little bit, the reason why I'm asking you that is we've started the year on a difficult note. Now, I'm just curious to know how much we can ascribe this to what's going on with the dollar, what's going to happen with the Fed, and therefore will the impact of those actions be felt gradually through the course of the first half? Or is this only the beginning? And in fact, when those actions take place by the Fed, we will see much bigger moves, that will hurt emerging markets like India.
Okay. So basically, the base case scenario is that with commodity price correction, the huge amount of economic surplus which was being transferred from the commodity consumers in Asian economies to, let's say, Middle East, Latin commodity producers, comes back to the commodity consumers in India, in other parts of Asia, and the consumer response. See, you look at your fuel prices, they're down at least 10 to 15% across most economies. So consumer being consumer, he's going to come back and spend that money on something else. So, and corporates, having seen their raw material costs go down sharply, both on soft commodities and some of these petrochemical inputs, etc., are going to give promotions. So you need to see that demand elasticity play out in the economy. If demand elasticity play out, we're going to forget all these things. At the same time, because of the structural issues in the world, because of central banks doing all these pump priming, there are risks that should deflation gets even firmly entrenched in Japan or Europe, you may see one of these tail risks emerge. So that's really the fear market's moving through, and I think that's where if we kind of pass next 1 or 2 months peacefully, people look forward and look at the growth part of it, and valuations would be comforting, and that's how things play out for 2015.
Rahul, the space that's seen the biggest rally in India is banking. We've seen 25-30% rally in a matter of 3 months on the bank index itself, and of course, individual stocks have outperformed even further. Do you think that's the space that can continue to lead the market? It was the leader of last year, but if the market recover, would this be the space where you'd be bullish on?
Yeah, I think private sector banks are clearly the most attractive bet in the market. And again, the story over there is gaining market share from the public sector players, the asset quality much better. And we'll see a lot of these vulnerabilities on asset quality, particularly for infrastructure, for these commodity lending get exposed now, when there is a real pain in terms of the final product prices for some of these projects, some of these companies. So we continue to like private sector players in the Indian market. And if you look at valuations still are reasonable at 12-13 times forward earnings. So I think that still post the pullback remains the most attractive part of the market.
What about IT? We'll have Infosys numbers on Friday, and this is going to be an interesting space now.
I think IT, you've got to look at these companies from a 15% compounding machine. So the key thing is to buy companies between 13 to 17 times earnings. If companies get expensive at 20-22 times, you'll see some bit of a valuation correction over there, because growth is not going to go beyond 15%. Because what's happening is you're seeing cloud, you're seeing the biggies like IBM take part of this growth which is coming. So the base is much larger for these companies. So I think somewhere valuations realign to this, and accordingly you'll make money in this. And we've often talked about currency benefiting these companies, but what we've seen over the last 4 years is rupee's gone from 45 to now 63, and all the gains have been given back in the marketplace to get revenues, basically.
Okay, fair enough. What else do you like besides,
so private sector banks is something we like. It's a big overweight across our funds. What we also like is healthcare. I mean, valuations looked a bit rich post a rally we saw from June, but on any pullback would be looking to buy over there. Discretionary, consumer discretionary looks attractive. So if you take a call that you'll have, again, this economic upturn for next 3-5 years, you look at the categories in India, consumer discretionary category. You look at autos, it's a 2.5 million market. And look at China, again, the same passenger car market is a 17 million a year market. So you've got a long way to go for some of these consumer discretionary categories, which would include autos, travel, tourism. So that's something we're extremely bullish on. Staples is something which is expensive. I mean, it's tough to justify buying a consumer staple company at 30 times on FY 17. So Staples may do well if
try telling that to all the people who are buying Hindustan Unilever over the last 2 days, Rahul.
Well, what I'm saying is your call works if the world goes towards deflation, but if the world comes back to growth mode, then I think this is just a hiding place for next 3 months.
Okay, fair enough. Are you at liberty to take names of stocks
no,
that you like?
I would refrain for taking names.
So let me put it this way. You've mentioned sectors and stocks that you like and maybe staples that you don't. Any negative surprises that we should expect from earnings season? That's the final question.
Yeah, I think numbers are going to be soft. Now, how soft are they going to be on the revenue side is to be seen. And also, how would the investors react to it? Like the way I said, it's an overowned market. You've got a lot of ETFs which bought post the event, which was elections. So, do these guys unwind? Maybe. And again, would you look at that as an opportunity to add? Yes. So, like the way I said, it is a structural story for 3-4 years, but growth is going to be slower than expected. So, you need your valuation comfort for you to make money in the market, basically.
Fair enough. Then we'll test what somewhat of a correction looks like this time around. Rahul, thank you so much for joining us for the